So this is going to be a hot take, highly controversial, and you guys are going to have your own opinions on this video, number one, but I'm very concerned with what's going on in our markets. Now, I'll explain this. I'll go over what this potentially could mean for Tesla and why I'm concerned, because let me just say it like this. If there is a scale of maybe 10 is super bullish, all in, no cash, just balls to the walls, all in stocks, that's 10. And let's say 0 is all cash, all puts, sold everything. I'm at like a 2.5 because of events that have happened this week. Prior to this week, I was at like a 6, maybe 6.5. Not all in, plenty of cash, maybe like one hedge or so, just in case I was wrong, a bunch of calls. I'm a lot more concerned ending this week than I was starting this week. And my goal on this channel is to, one, be as unbiased as possible. You know, I haven't sold anything. I'm all in this market from that perspective. Sure, I have a couple hedges on my portfolio. In the event things do go south for markets, my long positions are stable. They're secure. Those hedges give me a way to, you know, not have to sell my long-term stocks, right? And I'm 40+% all in on Tesla and pretty concentrated overall in my portfolio. But long story short, I'm pretty damn concerned as we end this week, and I'll explain exactly why that is. If you are watching this video, go ahead and vote on the poll that is out on the main channel. I want to know where you are at. If you're at a 0, if you're super bearish, if you're at a 10, if you're all in and super bullish, and share your thoughts on that poll or in the comment section as well. Feel free to let me know where you're at on this scale down below in the comment section as well. I would love your feedback because yeah, I think we're in a little bit of trouble here. Now, I do want to preference this video with saying I am not a financial advisor. I'm not a financial planner. I don't have a crystal ball, nor am I a fortune teller. I think a lot of you guys, whether you agree with my take or not, I think you'll be able to at least agree with you know what I'm saying here is probably not the most ideal situation, right? Whether you're bullish or bearish, I think we can all agree the data is the data. And I think the hardest part about all of this is clearly the timing. Like, I have a 100% confidence in what I'm going to say in this video is correct. Question is when, right? Does it happen on Monday? Probably not. Does it happen next month, the month after that, 2025? When do things actually get bad? That's the biggest question as well. Let me know your thoughts down below in the comment section. But let's start off with why I'm so concerned. Well, number one, and this is the easiest thing to say, is clearly recession risks have risen. Okay? From my perspective, there is not a 0% chance of a recession. There's probably a 50% chance of a recession, maybe 40% chance of a recession over the next 12 months. I think that's probably logical. I think that's probably correct. Now, the markets are assigning a 0% chance of a recession. According to the headline, S&P or NASDAQ being at or near all-time highs. That's a fact, right? We're not expecting or pricing in a recession. Compare that to the end of 2022, where stocks were 40% lower than where they are today, and there was a 100% chance of a recession over the next 12 months, according to Bloomberg. We've come a long way from that point, and I don't think there should be 100% odds of a recession. Clearly, that would be wrong, but I think 0% is also wrong. One of the things, and that's kind of the overall premise of this video, one of the things that has me a little concerned right now is there is a lot of disparity in this market. as I talked about in the last video, as I showed in the last video, there's only about 36% of stocks trading above their 50-day moving average. Yet the S&P and the NASDAQ are at all-time highs. I understand, okay? That can happen, and it happens sometimes. All that means is the markets are more narrow. Nvidia, Apple, Microsoft, Google, Meta, these companies, they're the reasons why the markets are holding up so well. But take that overall percentage of a recession narrative into mind. The markets have a perception that big tech is just immune to any potential recession risk, where the Russell is not. That's why the Russell has been getting punched in the face recently, including today. The Russell down almost 2%, and the S&P was down about 0.2%. The markets are saying, if we go into a recession, Nvidia is going to do fine, Microsoft's going to do fine, Meta's going to do fine, Amazon, and all of your other big tech names. I'm here to burst that bubble. That's not true. In 2022, that wasn't true. In 2024 or 2025 or any time in the future, that will not be correct. Now, I understand to some degree, people think Nvidia will be recession-proof. And I do agree with that a little bit more than like a Microsoft or a Meta or a Google or certainly an Amazon or an Apple that are by nature consumer cyclical companies. But let me just tell you right now, when it looks like we're going into recession, when recession odds actually rise out there, when Bloomberg starts reporting a 10, 20, 30% chance of a recession, you know what companies are going to do? They're going to do what Amazon and what Tesla have started to do. And they're going to say, we have 25,000 GPUs. They're running. We're really not making a product. We're selling a service that is bringing us in any money. We're spending billions of dollars a quarter on these GPUs. Maybe we don't need more right now. That's what will start to happen. And Nvidia's numbers may not be as great as we think. Now, that's hypothetical. That is in the event recession risks do rise, in which I think they will. So to sit here and think Nvidia's demand will not be impacted at all based on a recession, or Microsoft or Apple or Amazon or any of those other companies, is fugazi. That's not true. That's BS. So I think we've kind of established the basic principles here, right? Again, markets are assigning a 0% chance of a recession if you look at the S&P and the NASDAQ. Okay, fine. I think the odds are a lot higher than 0%. Maybe they're not 100. Maybe they're not even 50. Maybe it's 20, 30, 40%. I think that's a little bit more reasonable of, forward pricing of expectations. You also have this perceived narrative that big tech is safe if we do go into recession. And I think that's also not true at all. Now, the thing that ultimately makes me the most concerned, why I started off this week around a 6 on the, 0 to 10, bear being 0, 10 being super bull scale, why I'm pretty much going from like a 6, 6.5 down to like a 2.5 is really because of the Fed. Now, there was data this week that definitely plays into that, but the Fed made it unequivocally clear to me that they are waiting for some kind of weakening, something breaking in the economy to cut rates. And the fact of the matter is, things are weakening. Things have not broke yet, but they are weakening. And the Fed, after 3 months of rising inflation, January, February, and March, came out last Fed meeting, and Jerome Powell sounded very dovish. He said, I quote, "Yeah, first quarter inflation data hasn't been good, and we expected the road to be bumpy, but we're still optimistic inflation will come down throughout this year." That was last Fed meeting. What we got this Fed meeting this week was a Jerome Powell that did not sound confident in anything, that did not answer any questions, that gave us zero forward-looking guidance on inflation. It looks like they just threw dots on the wall for their dot plot. not expecting unemployment's going to rise at all, expecting GDP is going to stay the same at around 2.1% for this year, expecting PCE is not going to make any more progress this year, and only one cut. It's like the Fed is riding a bike, you know, as fast as they can on a trail by the Grand Canyon. If you are someone that is international, the Grand Canyon's like a huge canyon tourist attraction with steep drop-offs in Arizona. And they're just going as fast as they can on the trail, heading straight for a drop-off. And they don't see it until it's like right in front of them, right? That's what the Fed's trying to do. And ultimately, historically, the data would say the S&P sells off about 23% over the course of 200 days if the Fed is cutting rates because something broke. Now, the biggest question is, when does something break? And I don't have that exact answer, but I think we're going to get more signs of breakage over the next couple of months. And I think this is a very telltale post that I think you need to see this, everyone. Now, it's from Carl over on CNBC. He actually shared this from DRW that says, Powell has no room to get hawkish. Unemployment rate is 0.6 off the cycle low in the last 4 cycles. Amiding the pandemic, when the rate was up 0.6, momentum took over and the rate rose from that point on with a fury. And that's essentially us going from 3.4% unemployment to 4%. And what tends to happen when you get this rise is the next report is higher. The next report is higher. The next report is higher. It seems to go, the unemployment rate gets real momentum above, you know, this threshold. Now, whether or not that repeats or not, I think it will tell. It's 100% accurate over the last 4 recessionary cycles. So maybe it doesn't do this again. Maybe the next unemployment rate falls. Wouldn't that be good news? I think that would be fantastic news. But based on this, it's probably not going to happen. The next jobs report will be Friday, July 5th. We are expecting currently, and expectations will change a lot, we're expecting about 160,000 jobs will be added, and we're expecting the unemployment rate will stay the same at 4%. I think the markets are going to start paying a lot more attention to that unemployment rate and not necessarily just the non-farm payrolls. Now, even what we've seen this week, I believe that was yesterday, you had initial jobless claims come in over 240,000. We were expecting about 220,000. That tends to be one of the more leading indicators of what's going on in the labor market, and it certainly looks like things are not on a good trajectory. So I think July 5th is going to be the next big event for our markets. You're obviously going to get CPI a couple days later on July 11th. That is going to be a Thursday, and we are expecting core to come in at 0.2, year over year to come in at 3.2, headline to come in at 0.3, and obviously all of these, again, these estimates will change. But the way that the Fed was this week was very much like the economy is bulletproof. The economy is doing fantastic, but yet we just hit a multi-year high for unemployment and zero regard for what could come next, that there could be weakening. And that just told me the Fed wants something to break, that unexpected weakness Jerome Powell talks about that could cause the Fed to, you know, U-turn or cut rates or consider cutting rates. It seems obvious to me that they actually want that to happen or need that to happen before they are willing to cut rates. And the data that really kind of sent me over the bear edge today was the Michigan consumer sentiment numbers. Now, they all missed. They all came in really bad. 5-year inflation expectations rose, but specifically Michigan current conditions. We were expecting a 70.5 number, and we came in, oh crap, where'd it go? We were expecting a 71 to 70.5 number and came in at 62.5. Current conditions, the way people feel about the economy is at a 12-month low. If you look at the last 5 years, the only point that we were lower than where we are today, and you know, started declining, hit the bottom, and started to, you know, move higher from that point, was June of 2022. You hit 53.8. And what happened was current conditions were declining for a while. But remember the first half of 2022, we were actually in a technical recession during this moment in time. Now, current conditions have plummeted from 82.5 back March of 2024, 3 months ago, down to 62.5. This is the most aggressive collapse of current conditions we have seen since the Rona. And mind you, we are much lower today than the low of the Rona. Now, what I think is even more damning is when you look at this on a max chart, going back to when the survey started back in the 50s, you are as low as you were around there, a couple points off the low back in the great financial crisis. So sentiment is roughly as low today as it was during the great financial crisis. Now, what's actually interesting about current conditions is you actually see it correlate a lot to the markets. If stocks are doing well, conditions tend to be better, or current economic conditions tend to be better. If stocks are doing poorly, they tend to be worse. What's happening right now is stocks are at all-time highs, 401ks presumably at all-time highs as well, the average person's portfolio at near all-time highs, and people still feel like crap in regards to the economy. The way that I look at this is pretty simple. Inevitably, eventually, this will get reflected in the data. And if we get any data that's even remotely close to what the data looked like in 2008, stocks are grossly mispriced. Grossly mispriced. If we even see the odds of a recession rise from 0% today to 30%, 20%, 40%, 50%, stocks are grossly overpriced or mispriced at the bare minimum. And I think it's more of a time game at this point. Now, with that said, it is an election year, and if things start to look bad, then the Fed's going to be cutting rates. But again, I think a lot of the markets are programmed right now to think rate cuts are great for stocks. Historically, they're not, because historically the Fed waits too long, and it looks like exactly that is what the Fed is doing again. They are waiting far too long to start cutting rates. They should have already cut rates at least once this year, if not the last 2 meetings themselves. And that has me concerned because I don't think the Fed's going to get this right. I don't think the Fed's going to save the day. And the day of reckoning could come in the next couple of months. Now, again, I don't think this is going to be a next week event. I don't know if this will be a next month event. But 3 months from now, I think we're going to be in a worse off position than we are today. Zero Hedge posted this. I reposted this. Tom Lee reposted this as well, which is kind of confusing because he's super bullish on stocks, and this post is quite the opposite. Zero Hedge says, University of Michigan buying conditions for durable goods crater. The Fed is officially behind the curve. Yeah, if they're behind the curve, that's not going to mean good things for stocks. Again, markets are just so used to hearing rate cuts are good. Not all rate cuts are good. In fact, if the Fed were to come out and cut rates, on Monday, stocks would sell off probably 5% across the board because they're going to say, why is the Fed cutting rates? They must see some kind of huge disaster coming for the economy. Right? So if the Fed cuts rates into a strong economy, that would, in theory, probably be good. But if they wait for the data to get any worse than where it is, you're going to be in for major downside. And again, stocks being this mispriced could set you up for big downside. could. Again, I'm not a financial advisor, but just to get back to where you were in November of 2023, that would be downside from here in the S&P of about 25%. I find it quite logical that we could fall to, the November 2023 highs, or even your July 2023 highs. That would still be a fall of about 16% from here. I don't think that's off the table the way that the markets do, or the way that the markets are pricing itself. It just feels so mispriced from the perspective of risk management. Now, again, things have not been beautiful, right? If you're in Magnificent Seven stocks, you've done well. If you're in the S&P or the NASDAQ, you've done well. But actually, under the surface, things look pretty rough. I mean, the Russell's down over 1.5% today. That's not good. And it seems like areas of the markets that are economically sensitive have been underperforming. And that makes me just wonder why Wall Street thinks big tech is immune, but sell the Russell and buy big tech. The logic doesn't make sense. They will be affected. Now, to make all of this worse, what happens is you normally start a new year, like 2024, with earnings expectations that are really high, too high. What happens is you go through Q1, Q2 earnings. Analysts typically lower their earnings estimates. What's happening this year is estimates started high, around 11%, 10-11% EPS growth for the S&P 500 this year. What have they done? They've went higher, now expecting close to 15% EPS growth this year. That's not a problem, potentially, for 2024. But as you are now in the second half of this year, Wall Street's looking forward to 2025 already. If recession odds rise and EPS estimates fall, yeah, that's not setting you up for a good second half of this year. So from all of that perspective, I'm pretty concerned. Now, you also have other data like ISM data that's showing a slowdown as well. The PPI data that showed actually disinflation in producer price inflation or index. That's not necessarily a good sign for the economy as well. If prices are negative, if they're actually falling, that's typically a sign of economic activity slowing down. All of this, the Fed didn't care about. You also have the household survey for non-farm payrolls showing over 630,000 full-time jobs have been lost this year, and only about 286,000 part-time jobs that have been created. I mean, there's so many data points you could point to that are just getting worse, and the Fed is incompetent. I would be a lot more bullish today if the Fed had came out and was dovish. Was like, hey, we have problems out there. We're monitoring them. We're prepared to cut rates. We're thinking about cutting rates. None of that we got. None of it. And they will be behind the curve. They will be wrong again. And the question really is, when? Now, I think there is some good news in all of this, right? As I said, small cap, interest rate sensitive stocks, they have already took it on the chin. They've already got punched in the face. They are much better priced, maybe not fully priced, but much better priced for some kind of recessionary event. Compared to the NASDAQ or the S&P or your AI stocks for that matter. So for a stock like Tesla, yeah, sure, there could still be downside, but the stock's already fallen a lot. So I think the downside could be much less. And at some point, you got to say, Tesla specifically is already priced for a recession. Maybe rates falling when they do fall could actually be a more net positive than an actual economic downturn for Tesla stock. Now, maybe I'm wrong about all of this. Maybe I'm letting the bear get the best of me today. Maybe I'm looking too far into the data. Maybe the data will start to look better. But I'm telling you, if July 5th's unemployment rate goes higher, you will likely get a sharp sell-off in our markets. Because one, the Fed's not expecting unemployment's going to go higher. And the markets are expecting this soft landing. If that chart that I previously showed you is true and is the trajectory that unemployment will go in, you will start to have lots of recession fears in the month of July. Wouldn't surprise me if that happens. If not, I think August could be a troublesome situation as well. Now, the Fed still has another chance to cut rates July 31st. But if the Fed is cutting rates by July 31st, that would mean something broke. And if the Fed doesn't cut rates in July, they don't have another chance to cut until September. They're probably not going to cut right before an election. The next Fed meeting's November 7th. They're probably not going to cut right after, literally the day after the election. December may be the first time that they feel confident to cut rates, just to not be as political. And I think by then it's going to be far too late. Then you're setting up for a rough 2025. Now, depending on who actually wins the presidency, more cuts could be in the cards, less cuts could be in the card for the other candidate. I mean, we'll have to see. That's projecting out too far. But long story short, I think recession odds being priced at 0% in our markets today is grossly wrong. At least 20, 25, 30% should be where the markets are priced. And I think it's possible that does get priced in over the next 1 to 3 months. And to be honest, I think if you get the unemployment rate that goes up any higher than here, and Wall Street will start to price in a greater chance of a recession. So I think July 5th is going to be a huge day for markets. Wouldn't surprise me if stocks do kind of sell off a little bit into that report on July 5th. But afterwards, that's going to be the big thing to watch. So let me know what you think about this down below in the comment section. I would love your thoughts. Again, maybe I'm just reading too much into the data today, too much into, you know, the bear side of things. I don't know. I would love your thoughts down below in the comment section. Wouldn't blame you if you are hedging your portfolio right now, just to be honest. So thank you for watching. Hit the like button and subscribe to the channel. Remember to comment down below, where are you at? Are you at a 0? Are you at a 10? Go comment on the poll as well. But most importantly, enjoy the rest of your day and your weekend. I will see you in the next one.